So today is day 13. It's kind of crazy. We're almost done, like actually. Day 13, and I think it's risk management. I looked. Yeah, risk management. Okay. So risk management, blah, blah, blah. Risk management would be pretty cool. Um, because it really depends on like what you're trading. There's going to be multiple different types, and I'm going to just go over the ones that I know the most about, which is going to be like cash accounts. Um, Cash accounts, I would just go like options and then like fundeds, right? Slash like futures. So there's going to be like a two different breakdown in here, just no matter which one you trade, there's some value. Um, and yeah, we're just going to be drawing on the charts to kind of explain it and using text box to go over it. So cool. Let's do futures first, since this is futures based thing. Make that a little bit bigger. Okay. Futures. So when you get a prop firm, oh, I need to pull that up as well. Let me see. Where's Google? Let's do Top Step. Just for like basic sense. Hopefully it doesn't make me like sign into my account. Our program, do trade Top Step X. Okay, here we go. So cool. Okay. What I'm gonna do real quick, just write this out. 50K minimum maximum losses. 2K. And then you have 100K. And that is 3,000. And then 150 is 4,500. Okay. So these are for, let's just do Top Step. Right. And it's universal. It's going to really depend on, you know, which one you go with, but you can easily use this like rule of thumb, or I guess you would call it like an algorithm that we're about to go over, and just plug and play with your different settings or what your different rules are. So with the Top Step 50K account, you have $2,000 worth of risk before you blow the eval, blow the account, blow whatever. Okay, and that's kind of going to be a universal thumb in the entirety of an eval or of a Top Step, in my opinion. And then we'll go over the options and whatnot. So cool. So one of the things that I like to do is you got to add, like, with the fundeds, you're really not risking a lot of cash on cash. 50K accounts are 50 bucks, 100K, 100 bucks, 150K is 150 bucks. Plus activation fee. Activation fee, I believe, is 130 across the board. It may be more. 130 across the board. Cool. Or you go with the no activation fee. Rules are the same. And then you get, it's just, yeah. Oh, you pay monthly until, yeah. Okay, you just don't pay activation fee. Makes sense. Cool deal. So they're, no matter what, you're buying basically extra risk, right? Everybody looks at it and they think, oh, well, if I get a 150K account, then I can trade 15 minis. And while yes, that is correct, it's not always necessary. I mean, one mini is literally 200 bucks and 10 points. So where's the calculator? I'm curious now. If we know that one mini in 10 points is equivalent to $200, I mean, is it like, I don't understand who or where or why you would really want to trade 15 contracts. I just feel like that risk is absurd, and you really have to have a pretty big buffer in your account. And some people like that, but it's very easy to blow your account going full port on any of these. And that's the whole idea, is when you think about Top Step, they're a company, okay? They're trying to make money to be profitable, right? It's a company. And the more times you blow your account and have to redo the eval process and spend more money with them, the more money they make. So everybody looks at it and they go, oh, I get 5 contracts here versus 10 contracts here. Why don't I get the 10 and then trade 10 contracts? Okay, well, you're looking at it the wrong way. And everybody knows this when you think about options or, measuring out the move. If you're willing to risk $200 on an option contract, okay, but you got to swing it overnight, then maybe you need to. Hold on, I got to take this call. Give me 60 seconds. I apologize. Sorry about that. My buddy has two dogs. One dog ripped the other dog's ear off, and he was calling me. Anyway, right? Everybody thinks when you get a funded, you're gonna max out your account, and if you did that on an options account, everybody know you're probably stupid, right? You don't full port. Full port is literally the most degenerate thing you can do, and then people expect you to turn around and do that with funded. Okay, you don't do that. You don't do that. I cannot express it enough. If you want to full port your account, you're breaking all the rules. Everything we're about to go over, if you plan to full port, go ahead, bam, just X out of the video. It's not even worth it. Worth calling out the Compound's a simulator, and it's not real contract trading. That's how Top Step makes money. Paying $100, being able to lose $2 grand. Yeah, right. And it's a fucking paper trading account, right? If you guys are new to trading, like 100% ready, go to Top Step, or don't even go to Top Step. Go to TradingView. Right here, paper trade. Bet. And then you can come in here and reset your account and put a balance of whatever, right? 50K. And then go in and practice and have your risk set. So it's like, oh, well, let me practice my eval, right? You don't risk your cash on cash. And that's something I recommend no matter what. But we're getting a little sidestepped here. What the different levels offer in Top Step and any funded is risk. Okay, if you have a high win rate, you don't need a lot of drawdown, ideally, before you start to make profit, right? So if you were to risk X amount of dollars and the account had X times 3 before you blew the account, that means you need to have one profitable trade with good risk management, risk to reward, before anything, right? That first or second trade needs to be profitable. It needs to be a good winning trade, right? If you have a lower, maybe, it's X times 4 or 6, right? That means you have 6 trades, 6 chances to get a winning trade before you blow the account, etc. And it goes on and on and on. And that's what different levels of these are going to offer. Don't look at it as how many contracts you can trade. It needs to be how probable are you to win a trade, okay? With that said, I like to risk no more than $500 per mini, okay? So max risk equals roughly 500 per trade, okay? Which is equivalent to 25 points on one mini. And then, oh shit, what did I do? Did I just delete all of it? Okay, cool. Right. And then 25 points on one mini, or it can be broken up in multiple different ways, right? You could risk, 12.5 points. I'm just gonna put points on 2 minis, right? That's one mini. 2 minis. And you can start to do backwards. Maybe you got to risk 50 points, right? For proper, let's say, looking at the chart, based on the chart, my stop needs to go here, but for my entry, that's 50 points. I don't want to risk more than $500 per trade. What size should I take? You should take 5 micros, right? because you want your risk to be no more than $500 per trade, in my opinion. Okay, that's up to you guys if you want to decide. If $500 seems like too much, then great. Change this to $250. And then guess what? You cut everything I just wrote out in half. 25 points on 5 micros. 6 point, I think that's what, 7, or what is that, 5.75? No. 6.25 on 2 minis, and 12 points on 1 mini. Right. That's up to you guys. But here's what you have to think about. And this is where things get a little more complicated in this. If you think about your risk to reward, everybody knows the ideal RR is equal to 1 risk 3, right? You risk 1 to make 3. Whether that be dollars, points, I don't care, right? 1 to 3 risk to reward is ideal, right? If you can get more, 5, 6, 10, great. But understand your risk is right here. So risk is equal to X, right? Whatever you want to put. I'm going to put 500. Sorry, 500. Then my reward needs to be equal, ideally, of course, things happen, you manage trades, to 1,500 if I do the ideal 1 to 3. Okay, that's not this one. Which then means I should be able to pass a 50K account. I thought it was 3K. Oh, that's max loss. I should be able to pass a 50K account in 2 trades, 2 winning trades. I should be able to build a buffer pretty quickly on my winning trades, right? Because if you simply play it out by curving, by the exponential curve or whatever it's called, let's say you start at 50K. First trade's a winner. Great, now you're at 51.5. Okay, you can lose the next 2 trades and still be at 50,500, $500 buffer, right? Your risk to reward, and then you can lose that 3rd trade and be at break even, okay? And all you're doing is all of this remains the same, but it's how many chances do you get? So on a 50K, we get 4 chances, aka we're just gonna put trades so you understand what I mean. And then on this, you get 6 chances. And then down here, what is that, 9, I think? 9 chances, right? So it's what is your win rate, okay? If you have a 75% win rate, great. That means you are probably going to have a really high chance of being fine on a 2K risk. If you have a 50% win rate, still fine, you probably will be able to get out on 6 chances. Shit, you might even be able to get free on the 4 chances, right? It's the game of chances, the shots you're allowed to take before you have to reset. And that's the name of this. Okay, the other thing is, since there is a profit target, 50 is 3, I think it's literally 3, 6, and 9, right? So it's an interval of 3, depending on what account you take. Then how quickly are you going to be able to get to your profit target? And especially on an eval, when you're first starting, you know, you don't want to spend 6 fucking months passing an eval. It's crazy to say that, but it really shouldn't take you 6 months. It should take you maybe a month and a half, 2 months, absolute max. And if it's not doing, if it is taking 6 months, you know why it is? It's because you aren't risking enough. Because you're risking maybe $50 to make $150, right? So then, let's grab another text box. If we're risking, let's do RR, if we're risking $50 to make $150, I don't even want to do this math off my head, even though I think I can if I think about it. My head hurts. If we have to make 3K on a 50K, divide by 150, means you have to make 20 winning trades, at least, right? I don't, like, that's just going to take you so damn long. That's going to take you more than a week. It's going to take you more than that. And even if you go less than that, it's going to take much longer. If you have 6 chances and you have to make 6K with the same risk to reward, you are going to take forever. Now, on the downside, you're not really going to die that easy, right? You're not going to lose because you get, divided by 50, 40 chances before you blow your account, okay? I think that's just unreasonably too much. You will find yourself sitting there just treading water, and you're gonna be like, wow, I'm moving too slow. Wow, I'm not making any progress forward. Why is it taking me so long to pass the account? So that's where, for me personally, now it can be tailored to you guys, absolutely can, but overall, I would say if you guys feel confident, you can risk 1,000. Okay, you absolutely can risk 1,000. I personally like risking 500, and if all of this sounds too much, risk 250 bucks. 250 bucks to 200 bucks, because then you get 10 chances on a 50K. Right? That's plenty. Plenty. If you are truly a good trader, now shit happens. Okay, you go on losing streaks, right? Roulette, it can land on black 72 times before it lands on red. And guess what? Your odds remain the same. So it can happen, and it does happen. But if you can make sure that, you know, you have a good win rate and you're not currently on a losing streak, which market conditions definitely matters, but you should be able to get it done in one of these risk on a funded. Okay? Understand overall here that your futures, or your size, your prop size, is not based on how many contracts you can take. Even if you're trading, you know, like 5 contracts, bro, is plenty. What is that? That's $100 a fucking point. $100 a point. I get it. If you build the wiggle room up, let's say you take a 50K account and you build it all the way up, you can eventually take that size on an express, on a live, on a whatever. Like, there's no cap once you build up that buffer. It's mainly for the eval. And get rid of all of that. Understand that based on the size, you are paying for higher chances. You're paying for a higher probability of you winning, which is why it's a premium. Okay? It has nothing to do with the amount of fucking contracts you can trade on a paper trade, okay? I can't explain that enough. So, overall, that's your risk. If you want to put this in your notes, great. The recap is really just risk anywhere from 500, give or take a factor of 2. Right? If you want to divide it by 2 and risk 250, I think that's fine. If you want to times it by 2 and risk 1,000, that's fine. If you really want to go to the wall, I mean, and risk just freaking, I don't know, you can't even risk 1,500 because you don't even get 2 losing trades, right? That's why I think, you know, it's probably decent. If you want to risk 1,500 on a 100K account, fine, you get 2 chances, right? But just understand, the biggest takeaway here is chances, and then risk to reward is going to be 50K. The other thing about risk to reward, actually, we're going to go over this first. We're going to go over sizing, and then we're going to go over, like, actually putting it on the charts. So cool. What I'm going to do real quick, I'm going to copy and paste. What is it, like Command A, I think? Yeah, Command C. Look at me remember the shortcuts. So, funded futures, tab, bam, bam. Okay. Right, just little bullet point notes today. Okay. Now, does that make sense to you guys so far? Like, is it pretty easy to understand? If you guys want, I can copy and paste this and put it in the chat so you guys can just copy and paste it. Just let me know. Alright, cool. Alright, now, options. We're going to delete this and delete this. We're going to go think options. Alright, so some of you guys are going to go over this. We're going to use a very simple rule of thumb that I was taught and that I will teach. 10, 20, 2. Right? I wish it could be a date because it would make a whole lot of sense. But I guess it could be October 20th, 2000, I don't even know, just 2. But it's not. It's 1022. Okay. And options are going to be, we're going to keep in mind like a cash count, right? I feel like if you're under 25K, I think it's 25 or 20K. I don't remember. I think it's 25. But if you're under 25K, then you have PDT, pattern day trader rule, that you can avoid by going to a cash account. So if you're under that, go to a cash account, use this rule. If you want to trade with margin, I don't get it. You can, but just that's not my cup of tea, so I'm not really gonna be able to help you out with that. Anyway, 1022 rule is broken down into 3 parts: 10, 20, and 2. 10 stands for 10% of your account size in one trade. Okay. The 20 equals 20% loss, and I'd put like 20% loss, and then like roughly, right? There's a little bit of slippage in there, so you know it's just the ideal loss per trade. Okay, which then 2 equals 2% of overall account. This makes it super easy to know how much size you need to be putting into a trade, how much you shouldn't be putting into a trade, and when to scale up. Okay, because that's a lot of questions I've been asked before, is when do I scale up my size? It's a good question, and this will walk you through it. So I'm gonna write down an example. That's not a text box. Let's say, example, you have say you got a 20K account, okay, that you're trading options with. That means max you want to be putting into a trade is 2,000 into a trade max. Well, I'm not gonna put max. 2,000 into a trade. Okay. If you lose 20% of that, that's what, 400 bucks. 400 bucks. 400 max loss per trade, which is 2% of account. Right? You don't believe me? I'm like 99.9% sure my math is right there. If the last one's right, then I'm good. I'm gonna double check just in case. 20K, and then times, what would it be? Times like 0.02? Yeah. Right? Makes perfect sense. I bet you money my phone rings here in like 2 seconds. Cool. Now, using the 1022 rule, one of them is more important than the others. Okay? The 2% of your account is the most important, and then the 10% of your account. Okay? As long as you keep, well, no, hold on. I think the max loss right here, which is that. Anyway, okay. We're going to get into how this is like changing. I forgot which one's more important. It's in my notes somewhere. I have a whole entire PowerPoint that's not out there that I can put out there for you guys on risk management. But we're going to go over a different example. So let's say trade example. I'm just going to put EX1. Okay. Let's say you are swinging a contract overnight, okay, into news, right? AKA, you're running a gamble. It's an educated gamble, okay? I see reason this is going to go higher. I got data on my side. I think, I've done my research. Everything is telling me that data will be bullish, and we're going to go up tomorrow morning. You still run the odds of being wrong. So, what is the max you should put into that trade? My opinion, you should put your max loss, the max loss per trade, $400 into the trade. And why do you do this? Is because you do run the risk of losing 100% of your trade overnight. World War III starts. Some crazy shit happens and tariffs come back out, or you're just wrong on the data the next morning, or IV kills you, whatever it is, you run the risk of losing 100% of that trade. So putting a max of the max loss you're willing to take, the max 2% of your account into the trade is fine, right? Because then if you're 100% wrong, you've only done 2% damage, right? Now let's go over another one. Let's do another example. Text box. Example 2. Let's say you have to risk is equal to roughly 50% of the contract, right? You want to let it breathe a little. You're cool. You're like, hey, you know, I don't want to really be like nitpicking where I take my risk at. You know, I want to risk, give or take 50% of the trade, let it breathe out, put some time in it. I got to worry about theta and all this fun stuff. Dom's, your mic is unmuted, by the way. And all this stuff. Been great. Put in $800 into the trade. Therefore, you're still aligned with the 2% of your risk of the account, right? It's all factors based on this. Very, very simple sizing type of rule. And then, let's say, hypothetically, when do I size up? Maybe the account goes to 25K. Well, what happens here? This goes there. 2% of that would be 500, and it's still 2% of your account, right? That's where you up. Now, where I wouldn't up, let's say you go back to the 20K, and now you're at 20,500, right? I wouldn't really, like, mess with that. Are you really gonna, like, up your size by 50 bucks into the trade, and then up this to, like, what? I don't even think, like, what is that? 425? Maybe not even. Maybe it's like 412.5. I don't know, one of those numbers. I wouldn't do that, right? That's where if you did like maybe every 2K, I would get it. Every like $1,000, every $500, upping your size just doesn't make sense. Ideally, it's every 5 to 10K. That's where you want to up your size, but as long as you stick to this rule of thumb, you should be good, right? Because let's say, hypothetically, you don't use your stop loss. Oh, I have wishful thinking, this is going to have to play out. And you have a max size of 10% of your account, but you accidentally let it run to 100% zero, then great, you do only risk 10% of your account, which is still really bad. And it's going to hurt quite a bit. But on the bright side, it's just 10% of your account. You still can come back from that, right? As long as you don't break the 10, you will survive, okay? If you want to up 10 a little bit, maybe you want to put it's an A+ trade, you have high confluences, or it's a high rating setup, and you want to go with 20% of your account, I think that's reasonable. Okay, I think you can up it a little bit. Maybe you want to risk, you know, 2,500 bucks instead of 2K, right? I get it. There's a little bit of wiggle room. Maybe the contracts are 50 bucks more than expected, and it's like not a whole number, so it's not exactly 2K, and you want to round up, whatever, right? You're allowed to play with it a little bit, as long as you're not putting 50% of your account or fucking 25-30% of your account into one trade. Be careful. Now, the way you can do that is if your risk drops. So just right here, if we're risking more money, you know, you want to put less into it. So let's say you're only risking 10% of the trade. This was a number. Hold on, let me make this back to just base. No, that was meant to be 400, I'm sorry. And this was meant to be $2,000. Okay, so let's say you're only risking 10% of the trade, right? You're like, oh cool, I should only be risking 10 to 12% of this trade if I'm wrong. Then you can up the size more and still stick with the 2% rule, right? Because then you're risking, you know, 10% of the trade, you can put $4,000 into it and still be aligned with the 2% risk on your overall account. So you can mess with the different puzzles and push one side higher than the other and move one down and play with it to find the sweet spot. Overall though, 10-22, 10% of your account, 20% loss roughly per trade, give or take like 2%, okay? And just risk, make sure you're sticking to about 2% on the overall account of risk if you lose the trade, right? Because then if you do that and we keep in mind the ideal risk reward, which is 1 to 3, then you know you're risking 2% to make 6%, right? And that's pretty healthy for me on one singular trade. I think that's fine. I think that'd be a fine trade. 6% of your account in profit on one trade, right? Maybe you get a little freaky with it, and next thing you know, you got a 1 to 10 risk to reward trade. You know, you left runners, it was great, you whatever. Then great, you risk 2% of your account to make 20%. That's very nice. Who's going to complain about 20% on your account in a singular day? Not me. Most people don't even get that in a year. So if you get that on a singular trade, that's fine. If you have a good win rate, even if you did the 1 to 3 at 2% and risk and make 6%, 2 winning trades, and you're already beating the S&P 500 on most years. The overall running, what is it, like 12%, I think, give or take? So you don't have to be a greedy bastard here. You guys can easily use proper risk management. Okay. Now, real quickly before I delete it, does this make sense to you guys? Mentorship, notes, bam. And then get rid of this. Yes, cool. Thanks, E-Red. Alright. Now we're going to get into a little bit more complex. Doms, I'm going to wait and see. Yeah, you're good, bro. As long as one of you guys say it like makes some sense, that's really what matters. Because if you guys are like, no, this makes no sense, then it's like, okay, let me reiterate myself, right? Okay. Now we're going to go over, again, futures versus options. Futures. And futures is super easy, right? It's a flat rate. So mini equals, you guys might already know this, is $20. This is for NASDAQ, so hold on, let me, right, NQ mini equals $20 per point, okay? Or $5 per tick. Okay. Space this out so it's not multiple lines. Okay. ES is mini equals $50 per point, or what is it, 12.5 per tick. Okay. And then MNQ is equal to 1/10 of the number for NQ. MES is equal to, what do you think, 1/10 of number for ES, right? MES and MNQ are simply 1/10 the size of a mini, so pretty universal rates, right? It's not frickin' complex. Okay, I think if you're gonna even attempt to trade futures, you need to understand point and tick value, and then just understand micro is gonna be 1/10, right? It's super simple. If you want to open your notes and write that down, if you don't already know it, cool. Everything has a different point value, a tick value, right? Gold is gonna be more. I think silver even is more than gold. RTY will be different. Everything runs on a different tick to point value. So if you plan to trade it, at least know. Yeah, silver's nuts. Silver's the crackhead baby. The coke baby. Okay. Pretty easy. Just next. Okay, next is here's where things get a little complex. Options. Okay, options are complex, but I do want to include it. Options runs on not necessarily a flat rate. Okay, because you have the Greeks involved. This is a futures fucking mentorship. I'm not going over the fucking Greeks. Okay, I'll share a fucking PowerPoint in here, and if you're interested, you can take the time to go over them and just send me the questions, or Google the questions, or talk to someone who trades more options than I do, because I hate explaining the Greeks. If you're not risking at least $100 to $200 per contract, silver's literally impossible to play. Yeah. Fucking gold's damn near with it. I mean, gold, you're risking $400 or $500 at least to catch even somewhat of a move, but that, I mean, yeah. Silver has it too, right? I thought silver had a micro. No, it does. It's not MSI. It's what is it? Is it that micro silver? And it's 1/10. I use yeah, tick. Wait, tick value is that? It's not bad. So what? How many limit? Wait, is this even a futures? No, this is not. I was gonna say something's not right there. $5 a tick. Holy shit. So what is that per point? So here's an easy way to measure things out if you really want to. Bro, what? You're risking $1,000 per point on a fucking... That's crazy. On a micro? On a freaking micro, dude? Oh my god. Yeah, so stay away from silver. Risk to reward doesn't apply. I mean, it doesn't even get any smaller than that, dude. What the fuck? That's outrageous. I didn't know it was that bad. I've only ever played SI. Yeah. I mean, I guess you really don't have to risk like the full point. Hypothetically, let's say you were like risking here to here. That's a point. Never mind. You know what? We're moving on. I don't even want to look at it. Keep me away from silver. Okay, options are a little different though. Long story short, because it's an underlying asset or has an underlying asset pretty much, right? So you have delta. Delta is the relevant Greek for risk to reward because delta equals rate of change of premium. Why am I forgetting how to spell premium? I spelled whatever. Rate of change of premium per $1 on underlying asset, right? If you don't, underlying asset means like if you're trading a Q calls, the underlying asset is QQQ. If you're trading a SPY put, underlying asset is SPY, right? Underlying asset is the ticker that you're trading if you don't know. And delta is the rate of change that the premium, the price you pay for the option contract, changes per $1 on the ticker you are trading, okay? And this is relevant because let's say hypothetically, D delta equals 0.5. Okay, 0.5, which is equivalent to $50 if you don't know. Okay. On, let's just give, in premium is equal to, let's just do 2.00, which is equal to $200. Okay. And then based on the underlying asset, you're risking one risk underlying. I guess it'd be more underlying risk, grammatically correct, is equal to $1. Then you're risking one delta. Okay, you're risking $50 per trade on that trade. $50 of $200 is what? 20%? No, 25%, right? Yeah, I don't think I'm an idiot. I think it's 25%. Right. So voila. That's how you measure your percent loss to gain. Okay. That's super fast. So, and this will trip you up because it gets a little complex. So, if you understand, and then let's just continue for this example, that'd be percent risk is equal to 25%. This comes from, I don't even know how you would write that out in like a formula. Because, well, it wouldn't just be, yeah, it would be, right? It'd be 200 divided by 50, and then that equals 4, and then you would put that into a percent of 10 or something. I don't fucking know how you do that. Or would you do 50 divided by 10? Hold on. No, not 50 divided by 10. You do 50 divided by, that's 500. 50 divided by 200. Yeah. Okay, so it'd be the other way around. It'd be 50 divided by 200. right? Because 50 is D, so then the overall formula is D divided by P equals percent risk. Okay. Now, that's with just a risk of $1, right? That's the, you know, D is equal to 1, right? So underlying risk being that. Cool. Let me make this a little smaller, and we're going to push this here, and we're going to show examples now. Because this gets, like, a lot of people get tripped up here. So example, I don't know how that happened. Example 1. Underlying, I'm just going to put UR, underlying risk, equals 0.25, okay? D is equal to, let's do a whole number, let's do 0.4, okay? Which is also equal to $40, hopefully you know that. And then your P we'll do equals to 100, okay? $100, or it'd be 0.1, right? 1.0. Okay, so that means then percent risk is what, right? This is how I want you guys kind of answer it. So, looking at this, underlying risk is a quarter. So a quarter of D, since that's a $1, and we're not risking a full dollar, we're risking 25 cents. So that would be D is equal to 0.1. Okay, the premium stays the same. The P is like remainder. There's no changing the fucking P right now. But then if you lose, take your stop at negative 25 cents on your underlying asset, then you lose 10% of your premium, right? Because then you would do 10 divided by 100 equals 10%, or yeah, it'd be 0.10, which, you know, if you don't know percent, right, you probably should learn, but it's 10%. I'm just going to save you the time, okay? So then let's do one more. Example, why do I keep doing that? Example 2. UR is equal to 0.5, okay? Premium or delta is equal to, let's do a rougher one, 0.6, okay? Which, again, just to reiterate the same point, is $60 in option value. Currently, example for me, I'm in a hood 110 call, purchase at purchase for 270. Hood is currently at 110. If it drops to 104, I'm out. That's 3 delta. Delta value on the contract is 0.4. I'm risking $120 or 44%. Yes, great. E-Red, yeah, okay. E-Red's getting it up. I don't know if you already knew this or it's like your first time hearing it, but yeah, I think that's right. Well, I mean, the risk is. I know that. Like, it's, I don't know the contract value though. Yeah, it's about 44%, because 135 would be 50, so it seems about right. Yeah, I don't fucking know. But roughly 44, 45, yeah. Right, I'm glad you, at least you know how to like risk it out, right? And that's really what I'm just going over right here. Your underlying risk 0.5, delta's that, premium we'll do is equal to 2.0, which is, again, 200 if you don't know. You know, percent risk is equal to what? Okay, well, we're not risking full delta, we're risking half. That's $30. 30 divided by entry price premium is that. I'm just gonna do it easily. 30 divided by 200 is 0.15, so it's equal to 15%. Okay. Why does it seem? It seems wrong. Does it seem wrong to you, E-Red? No, it's right. Risking $30. $30 on a 200. No, it's right. Yeah, I was about to say that seems right. Yeah, right. Hood upside is 120. 13 deltas to 4.3. Yeah, right. Okay, but here's where you can once again scale up using options, right? So if you're risking Let's, now that hopefully these make some sense, I'm gonna leave them up so you guys can like look at them a little longer. But if your max risk is $30, we'll go example 2, extension of example 2. Okay. If risk per contract is equal, where's equal sign? Equal to $30. Okay. And you guys are wanting to risk, you know, max risk per trade is equal to $200. Then how many contracts can you trade? Max contract size equals fuck, I'm trying to do basic math. Is it not 9? 9 times 3 is 27, right? No, wait. That'd be way too high. 10's 300, 5's 15, 6, 18. So you can do about 6 contracts. Okay. Or if you wanted to, like, you know, oh, well, I'll up the size and risk an extra $100, then you can do 7. Well, I don't even think it'd be an extra that. I think it would be, yeah, it would be extra $10, I think. I don't fucking know. But, right, makes sense, right? Because your risk per contract is this, based on the math. Max risk per trade is 200, so you just reverse engineer it. Okay, but you have to do whole numbers. You can't do fractional option shares, or option contracts, so whatever. Okay. Take a screenshot of this if you want. Oh, I'm jacking everything up. Fit everything in there. Okay. And then, yeah, there you go. If you want to screenshot it or do whatever, that's basically what it is. Right? Okay. Doms, that makes somewhat sense. God, this math fries my brain so badly. Yes, sir. Cool deal. All right, now, risk management side of things. Okay. So, let's say, honestly, like I don't even know where a fucking winning trade is, because there's not been any really this week. Who the frick just started following me on Instagram? Okay, let's look right here. Let's say you wanted to try and long out of this fair value gap, hypothetically. Okay. That risk is 20, you know what? 23 points, okay? So you could take 1 mini, depending on if you got the exact entry, right? If you don't get the exact entry, then you're risking a little more than $500, so maybe a little less, maybe you don't want to risk all the way down, right? Whatever, but you measure it out and then size of that using the futures contracts, right? So depending on where your entry is. One of the ways I like to do this in real time is you take the measuring tool, which is found 1, 2, 3, 4, 5 columns down from the top left, and it's called price range. Okay, take it and put it where you want to be stopped out at. I don't have clicked. Okay, now keep it on and magnet it to current price. Okay, when price fluctuates up and down and whatever, it will change the value because its magnet basically stuck to it, right? This will allow you to kind of watch when you need to be entering, or you know, you can use a little bit of common sense. I mean, realistically, it's not like a rhyme or reason here, but that's just an easy way to do it. If you don't quite know, like, okay, that entry's 31 points, I should probably take seven micros instead of 1 mini, right? So you can de-risk a little bit. You're under $500 per trade, whatever, right? With options, just go to QQQ, or we'll do like, I don't know. Let's do Target. I haven't looked at Target. Let's say, God, I haven't looked at Target at all. I have no idea if we're gonna find a single trade on this to show an example. Okay. Didn't even tap it. All right, whatever. We're going back to 5 minutes. Let's say you want to enter off of this fair value gap. Okay. Well, what is the risk of said fair value gap? Here to here. So that's 90 cents. I'm not breaking delta up by 0.9. Okay. I don't have the patience to do that. So that's 1 delta. Okay. So when you look at this, you're risking 1 delta. Let's say hypothetically, I don't know where the fuck. Okay. I have no idea where target has been this high. So I know it's been this high. I don't know where. Let's say hypothetically, you're risking, or your target is up into there. Okay. It's a 1 to 3. Right? You don't even get all the way up there, I don't think. I'm curious. I'm invested now. No, you don't. Right? So you can see how you can start to use that, right? This also works really well with supply and demand. Okay, let's say we come in, there should be a break and retest on here somewhere this morning. I saw this. Took a small little scalp off of it. Okay. You're entering. I'm risking half delta. Cool. Okay, what's my target? The next zone. To make roughly 2. Okay, give or take. Right, so I could have drawn the complete other way, but you have positive risk to reward. Okay, so you can learn how to size based on that using this, right? Finding where you enter at, right? Don't put it down there if you don't enter down there, because your risk is going to change. Maybe you enter there. That's a little more than half, right? Don't lie to yourself. Okay, so your risk reward is 2.3, right? And that's simply how you factor the underlying. Okay, you just measure it out on futures. You use literally point value or tick value, and then I was like, why does this look different than I remember it? It's because I'm on replay mode. Right, and then on here you use the underlying cents. Right, literally basically the same thing, except based on the contract you have is going to change delta. Super duper simple. That's pretty much it. And that's like overly complicating it too. So that's all I got to share for you. Your notes should consist of more than actually, yeah, I mean, I don't have the minis or ES or whatever. Right, options 1022. Futures, understand everything I said about the chances. That's your drawdown, discount size, mask risk. For me, roughly is about $500 per trade. I feel like that's plenty. You know, maybe if I'm extra confident, I'll risk a little more. And then, you know, just different point value of $500 on NQ, right? But make sure you understand the different point values per pair you're trading or whatever the contract you're trading futures wise, so that you can align with it, right? Because if you're trading ES, $50 per point, you can only risk 10 points, right? Pretty easy, pretty easy. Put some examples in there, some screenshots, whatever. Pretty cool. Tomorrow is how to take a loss, and I definitely have gotten experiences on how to do that in this past week. So that should make for a good one tomorrow. All right, guys. Adios. Appreciate you watching.